Thank you for joining us today for our Digital Energy Forums. We're going to give it another minute or so to allow everyone to join, and then we'll get started. So we'll be back in just a moment. Good morning. Thank you again for joining us today for our Digital Energy Forums. A few quick things before I hand it off to our presenter, Eric, who will kick things off for our natural gas market outlook. If you have questions at any time during the presentation, please feel free to submit them in the questions box on the left-hand side of the slides on your screen. We'll answer as many as possible at the end of the presentation, but if for some chance, or by chance we don't get to everything, we'll follow up with you directly by email. At the end of the webinar, you'll also notice a survey pop up on your screen. We would really appreciate it if you could let us know what you thought of the presentation and if you have any ideas for future webinar topics or improvements. Finally, we'll be making the slides and recording available following the presentation, so watch for an email with that later. Now, to introduce our speaker today. Eric Fell is a senior natural gas analyst at Genscape and has been involved in the energy market for 15 years. And with that, I will pass it off to him to get started.
Thank you. Welcome. Glad that everyone is able to join. Let me get the slideshow going. Happy to introduce our new Genscape's new supply forward product. 24-month view into, or really a two-season view is how to think about it, view into the supply and the demand and the corresponding implications with respect to storage that has regarding the U.S. market. Genscape has had a supply forecast available to the market for a number of years now, and this is a complementary product to that, or a corollary product to it, maybe is a better way to say it, where we're continuing to do the supply forecast on a price-driven, primarily price-driven and economic-driven way, and then I'm doing a demand forecast with the implications on price embedded into the product on a weekly basis. And for those of you that are subscribers to our production product, this is a very similar product in that it will be, again, based on market prices. It's not a price forecast. It's a forecast of fundamentals on a going forward basis based on current prices at the time. So it will be updated weekly, and as the curves change, as forward prices change, and as we get new information that allows us to, we're always calibrating and recalibrating our thought process and our models and marking it to market. It'll get a weekly view on how that is evolving over time as price changes and as fundamental dynamics in the markets change. So very excited to offer this new product and complete the picture with respect to U.S. nat gas balances on a forward basis by adding the demand along with the supply. And if you need to ask a question, you can do so. Please submit questions in the box, and I will get to them as time permits at the end of the presentation. I'm going to start on the supply side today and talk about U.S. production, Canadian imports, and then move into the various demand components, and then ultimately end with the inventory projections. And I'm sure some of you may have heard, and just to kind of give you the punchline, we have a very bullish view of what current prices mean with respect to balances. As I mentioned before, our supply forecast is done on a price-independent basis. My demand forecast is done with respect to current market prices. And we don't attempt to balance the market. What we're doing is saying at current forward prices and giving normal weather, 30-year normal weather, what does that look like going forward into the market? Obviously, weather is going to be probably anything but 30-year normal on any given month, and it can swing the balances wildly one way or the other. But if you do assume normal weather, and if we're right in terms of how we're modeling supply and demand, then current prices, what we're saying is they're too low. They would need to adjust higher. And just for the record, I have done this for over 10 years now, and used the same methodology. I used to work at Merrill Lynch Commodities, and I had many years where my forward balances were well above the bounds of storage. I had numbers that were over 4.5 and 4.6 TCF at times, and clearly we couldn't actually get there, but the implication was the forward curve prices are too high given our understanding of what was happening with the supply curve, and prices would need to move lower to adjust demand in response to that shifting supply curve. And what we're saying effectively today is the exact opposite is true, that the forward prices are in fact too low and will need to eventually adjust higher to reflect what we see as an imbalanced market with respect to storage. But we'll get to that at the end. The devil is in the details, clearly, and it sort of matters how you get there. And so without further ado, let's jump in. And so on slide 5, we're going to talk about production. And this is the existing Genscape production forecast that our subscribers will have seen for a while. It is, in fact, probably one of the most, we have been told, aggressive or bullish forecasts available in the market. We are predicting significant declines in terms of U.S. production. We really believe they're already upon us, that production has really already peaked or is peaking and is in the midst of its descent lower through 2017. And this is really driven by where, again, forward prices are. That's how the basis upon which we build our forecasts on both the supply and the demand side. And ultimately, it's a reflection of what drilling economics look like, our understanding of them. It incorporates changing efficiencies over time, and we've had tremendous efficiency gains over the years. We do continue to get those. We do incorporate those. And in the Northeast, it also incorporates, it does incorporate infrastructure, but I can talk about that a little bit further maybe at the end. But the risk of infrastructure in the Northeast is significant with respect to our production forecast. The rest of the U.S. is a much simpler dynamic in terms of trying to understand production, because it's not a constrained region from an infrastructure perspective and in general. And it's really a function of our understanding of type curves and our understanding of economics, how many rigs are going to be run, and therefore how many wells are going to come online, and the rest of the country. And the rest of the country is in fact already in decline. We're talking about the Mid-Continent. We're talking about the Rockies. All these other regions are in the U.S. besides outside of the Northeast collectively have already declined meaningfully, in fact, from the peak, and we expect that to continue given where rigs are. The Northeast is different. I can draw some analogy to the Northeast to those of you that have been in this business for long enough to go back about 10 years, and we've had periods where the Rockies and the greater Mid-Continent region were constrained, where production outgrew the available capacity, pipeline capacity to get gas out of the region, and that persisted for a couple of years, but then a significant number of new pipeline projects came online at the same time that new production started to grow, and the market didn't, prices fell to reflect the structural sort of oversupply problem the market had, so production growth slowed along with the new pipeline projects, and the basis in those regions were no longer constrained and reconnected. The Northeast, as you can draw analogies, but there are significant differences. The biggest of which, really, in my mind, is that it's in scope and scale so much bigger than the problem that was presented by either the Rockies or kind of just the Mid-Continent in general. And it also was it's just the degree to which it's persisted has been unique. Eventually, all of those basis regions sort of resolved with new infrastructure eventually eclipsing kind of the production growth by either a combination of new infrastructure or production growth stalling or even falling. We're not necessarily predicting production growth to fall in the Northeast. In fact, we're not. As you see, we're continuing to predict growth in production in the Northeast throughout, and so the production declines are really a function of more limited production growth in the Northeast while the rest of the U.S. Continues to decline. There's very little in the way of new Northeast infrastructure coming online this year. There are some very big projects slated to come online in 2017, but those have already been delayed, and there is material risk with respect to those projects, and it's a big risk in terms of what production might end up looking like if those projects were to be further delayed than they already have, and that clearly could be the case. At the end of the day, outside of the Northeast, which is in a large part infrastructure driven, we do in fact see at some point the infrastructure outpacing growth of production in the Northeast. That hasn't been the case yet, but we do not believe that at current rig levels you will actually fill all the new stuff if in fact it comes online. So that's the case that we're making, and it hasn't been true yet that it was true in the other regions, and our understanding of what the type curves look like in the Northeast suggests that that's going to be the case going forward. It's interesting to talk about rigs, or to sort of throw rigs in there and relate that to production forecast, and again, going back a number of years, but sort of relating this to 10 years ago or so, or even further, when the paradigm that was believed by the market, and it was borne out at the time by data, where no matter how many rigs we added, we didn't seem to be able to grow production. And so people sort of stopped paying attention to rising rig counts almost at some point because it just didn't seem like it mattered, that production couldn't grow. And the opposite is true now. People sort of some people sort of feel like rigs don't matter and production's just going to grow no matter what. And sort of the laws of physics would suggest that it is not the case, and it is definitely not the reality. Rigs do matter. Just the issue has been over several years that the number of rigs to grow gas production has fallen because of the significant gains in both the technology to drill faster wells, to complete longer laterals, to do more frac stages, on top of the fact that we have moved from better and better reservoirs. The Barnett was the best thing ever discovered, supposedly, and then suddenly we discovered the Haynesville, which was meaningfully better than the Barnett, and that was the best rock ever. No one would ever find a better reservoir. And then we found the Marcellus, which was not only better than the Haynesville, but it was also massive. I mean, it covered such a bigger geographic area. And now the dry Utica even appears to us that it's better even than the Marcellus. So not only are our technology, methodologies, and operational experience improving our ability to extract hydrocarbons much more efficiently, we're finding better reservoirs. So, but we take that into account into our forecast the best that we can in our understanding of where type curves are, how we think they will evolve, how efficiencies will evolve over time. Deferred inventories and infrastructure in the Northeast, and it does make it more difficult to predict production in the Northeast, admittedly, when infrastructure and deferred completions become major factors. But we do believe production is, in fact, declining in a significant way. And at current prices, outside of the Northeast, we don't see rigs being added, even at forward prices in 2017 and 18. It doesn't really make sense to throw extra rigs into the Rockies or the Haynesville, what have you. So that's the basis of our U.S. production forecast. On the Canadian side, it's interesting because we actually do see Canadian production, although we have U.S. production, like I said, declining both this year and then even more significantly on a year-on-year basis in 17. Our production forecast for Canada actually has growth through 16 before we see it turning over later this year, and will be down year-on-year in 2017. So on top of the fact that we have Canadian production growing this year, we also see the fact that Canadian storage came out of the winter with a significant overhang. I mean, just like the U.S., the Canadian storage balances came out of the winter near all-time records. And so it's a closed system. The gas either has to be burnt or stored, as the adage goes. And so if production continues, if they don't shut in any production in Western Canada, then given where storage balances are, it will be forced into the U.S. Whether or not it is priced to do so, that is not how I'm determining the Canadian imports. It's based on the S&D itself, and flat price is really kind of the main determinant of whether it will be produced or not. And then if it's produced, it again, burnt or stored, and storage is very full. There is a little bit of an offset in terms of the continued growth and demand You can see oil sands demand in Alberta up about 200 million a day year on year, and the seemingly impervious oil sands region to any kind of a price signal, and it just keeps growing. And when you think about the oil sands, I'm not an expert on it, but the fixed costs are massive. It's a multi-year sort of investment cycle where it takes a lot of years to bring these online, and the day-to-day marginal cost to operate, your marginal cash cost to operate, setting aside sunk costs, are obviously quite low, particularly when gas prices are as low as they are, because gas is one of the inputs, particularly the in situ production in Canada. So we do see significant increases in Canada for the summer. I have them up over a BCF a day year on year over the course of the summer, which is a significant offset to the declining supply that we see in the U.S. production. The net of it is, from a supply perspective, in this summer, we have supply down about 0.3 of a B. So the U.S. declines are almost offset by the increase in Canadian production. The real story in terms of 2016 isn't the overall supply picture, it's the demand growth that we're seeing and that we're projecting. 2017 will become more of a supply story again, as we see, again, continued production declines on both sides of the border. But on the demand side of the equation, it's really where we see the needle moving this year in a significant way. And before we get into the summer and the forecast, we all are well aware of how mild this past winter was in terms of gas-weighted heating degree days per NOAA. It was the second mildest winter we've ever experienced. And although we have seen on the residential and commercial side, clearly there's growing demand, a structural demand growth on space heating in respect to natural gas. So we're getting more. What that means is we're getting more demand per heating degree day, and that's being driven by two fundamental factors. One, the main one being fuel switching in the Northeast, where customers, Con Edison, for example, is switching multifamily units and office buildings from fuel oil number 2, 4, and 6 over to natural gas. And that's been an ongoing process for a number of years. Not only does it make sense from an economic perspective, they have banned, frankly, the higher sulfur fuel oil products. So that's part of a requirement from an environmental perspective as well. So it makes sense economically, it makes sense environmentally, and it's been a push that's been going on not just in New York by Con Ed, but by other utilities throughout New England and the Mid-Atlantic area. There's also there's no population growth to speak of in the Northeast, but there is some population growth in other parts of the country, the mountain region and the South, where you also get a little bit of growth on, kind of a per heating degree day as either population grows on the residential side or on the commercial side, you build out square footage, occupied or heated and lit square footage space from an office building perspective. And so it's not entirely population dependent. The commercial side is part of where this is happening as well. That being said, it's a subtle effect, and it gets trumped really by overall weather dynamics. And the degree to which you get heating degree days or not really is going to be the main driver with respect to winter time demand on from a space heating perspective on the residential and commercial side of the equation. And so the mild winter that we just had left us in a very similar situation to 2012. We came out of the winter with around 2.5 TCF in the ground, and that doesn't leave you, much room to inject. And so you have to restrain production if you can, or in particular, you have to get incremental demand. Go get incremental demand via, coal switching, and that requires a low price point in order to do so. Moving on to the next component of demand, just talking about this, keeping price low enough to get the coal switching required to stay within the confines of storage this season. And power demand, while lots of things influence power demand, weather clearly in the wintertime, heating degree days, in the summertime, cooling degree days, drive overall loads. We have significant changes on any given year with respect to the hydro output. Clearly, we're going to have a much, much stronger hydro year this year than we had last year, a much more normal year, in fact, maybe a little bit above normal. And then we have growing solar, growing wind, nuke output changes from year to year as well based on outages. So all those things impact power demand from a natural gas perspective, and then there's the concept of our loads overall growing or not. And just recently, we've gotten back close to the high that loads peaked back in 2007. And believe it or not, 10 years later, we're just getting to the point where overall power loads are starting to approach and getting very close on aggregate. In certain parts of the country, we're well above where we were in 2007, but aggregate U.S. loads are just now getting to where they look comparable to sort of the prior peak, and that also matters. I build the power demand forecast from a power perspective, meaning I forecast overall loads, and I forecast hydro, wind, solar. Those are a function of wind and solar are a function of capacity additions across the country. They continue to have new capacity added, and solar generates electricity when the sun is out, and it peaks in June, and that's when the days are the longest. It makes total sense. Wind is a little trickier. It clearly generates when the wind blows, and I honestly don't exactly know why it's the case, but seemingly the wind blows much stronger in Q2 than it does in Q3, so there is a clear seasonality profile to wind, but it's highly erratic. It can go up or down 20 gigawatts within the course of a day or two, and it's very difficult to kind of predict, and it can swing balances rapidly, but not in a way that can be really reliably predicted. But over time, from a day-to-day basis, but over the course of a month and a season, you can reliably predict what wind will look like based on capacity growth over time and kind of normal capacity utilization in a given month. This is the seasonality profile, if you will, of wind. And then nuclear is a function of capacity as well as outages. We're in the midst of heading into the peak of outage season shortly. This is actually a light refueling season this year, and and so far unplanned outages have been light, and so we're getting actually more nuclear output than we were last year, which is already a high utilization year. And then next year it's actually one of the stronger outage seasons in the spring with respect to planned fuel outages. So I go through all of the pieces of the equation on the power side, and then sort of leaves you, after you've subtracted the nuclear and the hydro and the solar and the wind, it leaves you with a portion of megawatts that will need to be generated by either coal or gas. And that's where price comes into the equation, and price, depending on the region that you're in, it has an impact in terms of how you generate that power. Is how much is it on gas, how much of it is generated on coal. And interestingly, you can see on the chart to the right that, and I'm showing you where my projection is this summer, and where prices were as of last Friday. That's when I did my forecast, and it's almost exactly on the line, incidentally, because it generally kind of holds. The hub ends up being easily the best indicator with respect to coal switching, even though there are basis differentials in regions that have an impact on it. The hub ends up being the thing that is the biggest driver, and I can get more into that in the Q&A. But I built a forecast regionally. I put the basis impacts in where they're relevant, and you still end up with a forecast that looks shockingly close to what you would get on just a very simple, where's the hub priced, and what does that imply with respect to overall gas burns. Moving on to slide 18, we've gone through residential, commercial, and power, and now let's talk about the exports to Mexico. We are predicting continued growth in exports to Mexico from a year-on-year or summer-on-summer perspective. I'm expecting about a half a B a day of growth summer-on-summer. It's important to understand that some people can do projections based on infrastructure changes. I actually dive into the actual fundamentals themselves and endeavor to understand them as well as I can, and why are these things happening, because just because you build a new pipeline interconnection doesn't mean it will flow necessarily. There has to be a reason for it to flow from a fundamentals perspective. And so this is just a picture to help inform the audience how I look at this, and to help educate you perhaps on what in fact is going on in Mexico. And what we've seen over the last several years is a significant growth in U.S. exports to Mexico. And there have been big factors on both the supply side and the demand side. You've seen Mexico from 2010 to 2015, the overall market in Mexico grew. but the U.S. exports grew much faster than the overall market growth in Mexico. And what was going on the supply side was declining dry gas production, some decline in associated gas, and effectively LNG has been flat over that time frame because it ramped up through the 2013-14 time frame and is now just ramping back down to sort of where it was in 2010 at lower levels. But we are predicting, I'm expecting a small decline in LNG this year. There are infrastructure changes happening in Mexico that are enabling this. It was always not really a question of how much gas could we export to Mexico on our side of the border. It was really a matter of constraints on the Mexican side where they weren't able to take our gas. And so what has happened is they're building out significant pipeline infrastructure on their side of the border to connect their systems and to take U.S. gas further down into parts of Mexico. And there's Los Ramones is the biggest of these projects, but there are others. Phase 1 has been online for a while now, and that corresponded with the NET pipeline in South Texas that's shipping significant amounts of gas to Mexico. Just will mention briefly that we also have a product. Genscape has a number of pride. Not only do we're doing this forward forecast, but Genscape has always been, for a long time, a data provider of real-time data on the energy markets and power and gas and oil. And we have a number of not only products that scrape publicly available data off of websites, but we also have proprietary products. And one of them is measuring flows across Mexico with the NET pipeline, which is an intrastate pipeline that does not report flows. It's the biggest point of gas flowing to Mexico on any given day at this point, and it does swing from day to day. And so we are really the only shop in town. And that doesn't necessarily help this long-term forecast, but it can help explain what's going on from a day-to-day basis. And it's interesting to be able to see the swings on that. But ultimately, the underlying fundamentals suggest this continues to grow. The industrial growth story in Mexico is real. The labor cost advantage they have, anecdotally, Ford just announced another plant that they're relocating essentially to Mexico. That's not a new story. That's kind of what has been happening in Mexico for years, are either just new plants getting built or plants effectively being relocated and displaced from the U.S. into Mexico to take advantage of a fairly well-educated workforce and certainly an inexpensive workforce, and the transport costs to get things from Mexico into the U.S. market are cheap. So that has been a driver behind the industrial growth. It has helped also increase the power loads. And within the power sector, I didn't break that out on a separate slide, there has also been not only power load growth in Mexico, but we have natural gas has been displacing fuel oil in the stack there. And that story isn't complete. There's still a few gigs of fuel oil generation left to displace, but roughly about half of the fuel oil generation has at this point been displaced by natural gas in the Mexican generation stack. Bottom line is we do expect continued growth of exports to Mexico. However, the 0.9 of a B that we increased in 2015, I think will be the high watermark on a single year basis. We're predicting on a total calendar year basis into Mexico, much lower numbers this year, between 5 and 600 million, and slowing down. And the U.S. supply has gone from being close to 10% of the Mexican market back in 2010 to closer to 45% this year. And so that's, once you start to become, the majority of the market, or at least at this point half of the market, it starts to become harder to grow faster than the market. It's sort of just the law of numbers and how they work. And when you look at the dry gas production, we've already displaced, a significant portion of the dry gas. There's not a lot of dry gas left to displace in Mexico. There is some, but the numbers on the LNG and the dry gas side are getting, ever smaller. And so the displacement game on that part starts to become, smaller and smaller, and then you're sort of left with, okay, you can't displace that stuff anymore. We're displacing most of the fuel oil, and it becomes really just a function of overall growth of demand in the Mexican market becoming the biggest driver going forward. And in terms of exports, LNG is really the major story, and it's interesting because, again, back to the analogy I gave earlier where, people believed that we could not grow production in this country, and no matter what we did with rigs, demand was continuing to grow at the time structurally, and we built all these LNG import terminals to import the supply deficit that we were certainly going to have. And what ended up happening was the shale revolution, clearly, and now we are turning these terminals around to be able to export gas out of them. And over the years, I've had lots of debates and discussions with people who never thought they would get built. We will never export LNG. Well, in all reality, we are building them. They are under construction, and Sabine Pass Train 1 is halfway through its commissioning process as we speak. And then Train 2 is on the cusp of starting its commissioning process as well. And each train is capable of exporting over half a BCF a day of gas in terms of real gas demand. It's closer to 600 million a day because of the fuel consumption that goes into the liquefaction process. And there are a number of cargoes, and each boat is about 3.5 BCF a day, or not a day, about 3.5 BCF. And each train, as it gets commissioned, our understanding is we'll need to run between 8 to 10 cargoes through its liquefaction facilities in order to fully test them and make sure everything is working properly before it is then deemed as a fully functional terminal and is turned over to whoever the owner is. Cheniere and Sabine are the first several trains, but Cove Point will be the next one that will come online that's not a Cheniere terminal. And so by the end of the summer, in fact, we think by July or August, we will have over a BCF a day, closer to 1.2 or 1.3 of what ends up being U.S. demand. And the slide I call it export capacity. I'm really measuring what that means in terms of U.S. gas demand. Again, there's a fuel consumption component that won't actually get put on the boats, but it will get consumed in the process. Those commissioning cargoes are going to go and ship regardless of any kind of condition in the market, because these terminals, in order for Bechtel to deem the terminal as complete and to get paid its money, which ultimately it wants to, it has to run these cargoes through and prove that it works. And then they cut the ribbon, and here you go, Cheniere, you have the keys and you can drive the car, so to speak. And then whoever owns the capacity behind it, the contract holders and Cheniere, will dictate how the facilities run. So the debate isn't about whether these will get built or not. That debate is over. There could be small delays with some of these terminals, but frankly, these things seem to be progressing at or better than the timelines, generally speaking, published. And I don't think that. And the point is, it's a possibility these in some cases some terminals even coming on a little bit early. I don't think any will be significantly delayed. The debate isn't on infrastructure; it's on utilization. That's really, I think, the interesting question. And it's not really a difficult secret to understand that the global LNG market is very complex. It is very well supplied. We are ramping up our new trains at the same time that Australia is undergoing a massive increase as well, and also at a time when the global markets feel very long energy generally, and LNG specifically, it feels like it's glutted, so to speak, and it doesn't feel like the world really wants all this new LNG. That said, demand does continue, we think, to grow on a global basis, just not as quickly as the structural supply growth comes online. Some people would take that to mean that then the U.S., because it's a well-supplied market, the U.S. won't export any LNG. I disagree with that for a number of reasons. One is the Marcellus is an example for this. The U.S. market in gas has arguably been oversupplied for a while, but the Marcellus continues to grow. So new supply sources can displace old supply sources even in oversupplied markets. But obviously you get into price wars, and price has to adjust in those scenarios. But anyway, just because it's a well-supplied market doesn't mean our supply can't hit the market to a certain extent. Also, just because it's oversupplied, it doesn't mean that demand isn't growing. It just means that demand is growing more slowly than the new capacity on the supply side. But there is inherent demand growth that is happening. There are new regasification terminals. 3 new countries built new regas terminals last year and imported LNG for the first time ever. And so while we tend to focus a lot on Japan, rightly so, they're the largest LNG consumer in the world, and whether or not they restart their nukes and at what pace, as a big impact, for example, on LNG at the global level, there are other places in the world where LNG demand is growing. Ultimately, the way I have thought about LNG export economics and what we will export is I have decided to use price again, the forward curves, as the indicator on what will be exported. And so I've used the Henry Hub versus NBP spread compared to my estimate and best understanding of how I believe marginal liquefaction and transport cost to be from the perspective of the holders. And just for the record, Cheniere is charging, and BG in the case of Train 1, 15% of Hub. So Hub plus 115% is what they're getting charged just to run the product through the terminal. And then you have to add the shipping and the port costs, the regas costs, and then even when you get to, for example, if you are going to ship it to the UK, you don't just show up at South Hook or Dragon and you just don't magically get the NBP price. There's a price to get it into the system there, and so those costs aren't zero. They add up. And I'm showing you a chart of the NBP to Henry Hub spread minus the marginal liquefaction and transport costs, at least my understanding of them. And I'm using that as the indicator. You can see that at the prices as of last Friday, the margin was very skinny in the summer of 17. It still is positive, so one could argue that as long as it's a positive number, it should just run. I decided not to model it that way because then you sort of get to this scenario where it is, when it hits zero, then you suddenly go from full utilization to zero just with a few cents. I don't think that's realistic. I think that that there will be sensitivity to price, and it doesn't necessarily have to go to zero, but it could be that it has to go through zero. The truth is I'm the least certain about this component of demand at this point than all of the other parts of the forecast. Ultimately, when I talked about coal switching earlier, clearly also a very price-sensitive demand component, but I have years and years of history to tell you why I think coal switching behaves the way that it does. And here's the real behavior you see in the market versus price. This is LNG side of things is new. We have seen the opposite, where when the U.S. and NBP prices go the other way, the U.S. imports gas, and that can swing based on that price. But on the export side, we have yet to see a single cargo go on an economic basis. All the cargoes that have shipped so far have purely been a function of commissioning. And the other component of this model is I am including the commissioning cargoes. So no matter what the price is, there will be some cargoes that go as the new trains eventually do come online. And then it's a function of price that I'm using to sort of weigh how much LNG, how much will we utilize the capacity over time. And that's not entirely a function of the U.S. price. NBP can change as well. So, it's going to change from week to week, and it's going to be interesting to see as we get past the commissioning process and BG and Cheniere take over, how much and how responsive this is to price and what the relationship really is. Because I have modeled this. I'm not at all certain that I've modeled it entirely correctly. It's my best sort of guess based on theory as opposed to actualized real past behavior, which is really going to be what we're going to need to see over time to understand how this works. There's also Cheniere has claimed they have sold a number of cargoes on a forward basis, and so how responsive this is to price in the short term also will be interesting because there might be some lags associated with how the price impacts cargoes being diverted or not shipped at all and those sorts of things. And also let's not forget that we still have the ability to import LNG into the U.S. If balances were to get tight enough and we were to really, it would be possible still to import LNG from somewhere else in the world. It's just that you have to actually go outside of Trinidad, any other place to get LNG in the U.S. We have to price over NBP to attract those cargoes. Moving on to the last piece I wanted to speak on the industrial side of the equation. We've seen significant structural growth in industrial demand over the last several years. It sort of gets lost. I mean, mostly our market has been a series of supply shocks for a number of years, and they do continue. And the demand side has been some structural growth. We have arguably seen a demand shock already on the industrial side. It's just that the supply shock has been so much bigger that it doesn't get as much attention. But industrial demand is growing, and the chemical sector and the refining sectors are the two drivers of this. Those were already the biggest sectors back in 2010, but they've expanded their share of the pie as the industrial market has grown, driven by those two sectors. And I'll dive more into details on those right now. With chemicals being the single biggest component, and this isn't just methanol and ammonia. I mean, there's a lot of other chemicals and processes that consume natural gas either as a direct feedstock or as a fuel. But on a going forward basis, and some of the demand we've already seen over the last that 5-year span have been ammonia and methanol, which are particularly intensive consumers of natural gas. They use natural gas as a direct feedstock into the process of producing ammonia and methanol. And last year we brought online 2 new world-scale methanol facilities in Geismar, Louisiana, one of which came online literally in December 27th of 2015. So while it was technically 2015, it's really a 2016 event in terms of its impact. And then there are a number of ammonia plants that are ramping up as we speak. There's a plant in CF Industries is bringing online a new ammonia unit along with some upgraders in its Donaldsonville, Louisiana plant. And its new ammonia unit should come online within the next few weeks. And when that ammonia unit comes online, the Donaldsonville plant will then become the largest nitrogen plant in the world. There are a number of other plants and units coming online with respect to ammonia and nitrogen-based fertilizers throughout 2016. It's a massive wave of incremental ammonia build-out. These things are in advanced stages of construction, and some of them have been delayed. There were a couple of them that were supposed to already be online in 2015. So these have been delayed to a certain extent, but make no mistake, they are already under construction. So this slide represents facilities on both the methanol and the ammonia side that are already under construction. It is already underway. These things take a while to build, a couple of years for a methanol plant, for example. So if things come online in 2016 or 17, it is already under construction. If I were to put a chart showing you the proposed plants and took it out to 2019, this would have over 4 BCF a day of potential demand. Under the current market conditions, I don't think, probably few, if any, of those actually get built beyond the ones that are currently being under construction. But there are a lot of projects announced that won't happen. I think that's also true on the LNG side. I think stuff that's not under construction may or may not happen, at least not until probably after 2020 at the earliest, which is beyond my forecast window at this stage. But the ammonia and methanol story is upon us, and we've already brought online, like I said, some methanol last year, early in 2015, and then late, and then the ammonia build-out is upon us, where there's a substantial growth in ammonia capacity in the U.S. this year. The other part of the story on the industrial side of growth over the last several years has been refining. Refineries consume over 3 BCF a day, either as direct fuel or as indirect fuel in the cogens that feed electricity and steam into the refineries. And what we've seen over the last several years are growing refinery utilization in the United States. And so all else equal, you're getting incremental consumption of natural gas because of the higher number of runs and higher refinery output. But we've also seen fuel switching at the refinery level. The EIA is kind enough to provide us with fuel consumption for refineries. Unfortunately, it's only on an annual basis, but you've seen the growth of the natural gas demand for refinery fuel has outpaced the growth of refinery runs and refinery output. And what we've seen is that the LPG distillate resid, basically oil derivatives or NGLs, have declined in terms of their consumption from 2009 to 2014. What I believe happened in 2015, one of the questions that I've already gotten, or why did industrial demand decline in 2015 on a year-on-year basis? And there are a couple of things going on. I do want to show you the next slide. It also helps. If you went back to the pie chart, metals are also around 10%, and steel production is the biggest driver of the metal side. And so we saw the lowest output in terms of crude steel in the U.S. and since the recession. And so there was definitely an impact with respect to natural gas demand, as much as maybe 150 to 200 million a day just in the steel side. I don't think it was that high, but it could have been arguably that high. I think also a significant impact, going back one slide to the refinery fuel, is that when you think about what happened with respect to oil prices last year, crude oil came down, and so the price of distillate, resid, and certainly NGL prices plummeted last year as well relative to natural gas. And so some of the switching that had been occurring in refineries, I think, certainly late in the year when those prices got really low, I think it reverted the other way. And I think some of the fuel switching refineries had seen switched back, so to speak. But that looks set to reverse in 2016 as crude has rallied. We see some of the NGL products balances tightening significantly in 2016 as well. And so we think that the fuel switching is likely to reverse course, and whatever we lost in refinery consumption in 2015 is likely to be regained in 2016. Likewise, on the steel side, I'm not an expert on the global steel markets, but we've already had 2 months, February and March, where we have meaningfully exceeded last year's output on a year-on-year basis. And so it seems, at a minimum, the comparison versus 2015 is very easy. It seems very likely that we will get an uptick in terms of demand on the steel side. And then finally, I also look at industrial demand on a weather-normalized or weather-adjusted basis. There is a material component of industrial demand that is a space heating fuel. I showed you the residential commercial slide earlier. It was a very mild winter. Last year was a mild year overall in December in particular, the mildest December ever, and that impacts industrial demand. You can have as much as a 4 BCF a day swing from the summer months into a very cold winter month. When you don't have a very cold winter month, instead of being 4 BCF of incremental demand, maybe it's only 2, or 3, and so you do lose a significant amount of quote-unquote industrial demand just because you lose the space heating component of it. And we have an easy weather comp going forward into the summer and through December, and so we should see a reversal of that. And the weather really masked some of the ongoing inherent structural strength we're seeing on the chemical side. We did have, like I said, a mild year in addition to weakness in the metals side of the equation, as well as I think some reversal of fuel switching in the refining sector that I think will reverse going forward. What that means in terms of storage balances, if you carry forward our projections on both the supply and the demand side, it means that this summer prices need to stay restrained in order to, because of where we started the season, near 2,500, 2.5 Ts, we have to put in a very small injection. It's going to have to look like 2012, and prices will need to stay near $2 in order to incentivize the amount of fuel switching we believe we need to get to sort of 4 Ts. I do think we actually have, in my forecast, as you see, is right around 4 Ts for the end of OC. I do believe we have the ability to put in close to 4.3 Ts, or maybe even slightly over that, theoretically. That's based on the non-coincidental peak utilization of all the facilities around the country. It's not realistic to ever get to 100% on any sort of system. If you really consider 95 or 96% full as kind of being more realistic, then we can really get to about 415, I believe, is kind of a real plausible number to get to. So I don't think that 4 is a hard stop. I do think we could go higher. I think we can get a little bit above 4.1, but then beyond that, it starts to become problematic for the market. But what's interesting about the outlook is that once you get beyond the restraint you need this summer and a tight market based on low prices, our view of, again, both the production declines we see starting to occur now, carrying into 2017, along with continued demand growth on the ammonia side, the chemical side, industrials, as well as what we see on the fuel switching side. I mean, we do incorporate fuel switching, and at current prices, $275, $280, for Cal 17, Cal 18, we see the fuel switching does reverse to some extent, but not enough to offset the production declines and the growth and the incremental LNG exports that are priced into the market at this point. So we see the market being exceptionally tight and undersupplied. And when you carry an undersupplied balance over time, you start to get to crazy balances. I'm not suggesting we're going to go to zero. I'm just saying that at current prices and assuming normal weather, our forecast assumes 30-year normal weather, then we would be in a problematic scenario. Clearly, price would have to adjust. Or, if we get continued mild winters like we had last winter, this would look much different as well. And so those are the two things that can swing the numbers pretty significantly, and also price and time are two variables to sort of think about, because price is part of the equation, but it also takes a price impact over time. And not only does demand respond, the difference today versus 2012 is, or at least on the forward basis, we're now at a point where LNG can swing, I think, significantly based on the relative price, not a flat price, but a relative price of Henry Hub to global LNG prices in the market. And so and just using, again, NBP as an indicator, that can have substantial impacts on what we're predicting and what these balances look like. And then supply, while it doesn't respond, in a month, supply does respond over time. Just as an example, when Chesapeake a few years ago, we had a rally off of the lows after 2012, they added 5 rigs into the Haynesville, which over the course of a 12-month period, once those rigs were added, it had incremental production growth at the end of 12 months of a half a BCF a day, and that was just 5 rigs in the Haynesville. And so production can respond over time. You just need a price signal high enough, and you need time for that to develop on the supply side, whereas the demand side, fuel switching and LNG is more sensitive on a shorter time frame, I believe. I know coal switching is. I believe LNG will be more responsive on a real-time almost basis. But supply takes definitely a lag with respect to getting the rigs activated, completing the wells. So again, this is a forecast. We do supply and demand forecasts based on current market prices as of a timestamp in the CME curves for Henry Hub, for MVP, for Dominion basis, what have you, whatever is the relevant driver in a region. This product is to be updated weekly, and you'll see the evolution of our balances over time as price changes and as our thinking changes. And with that, I've concluded the presentation. I don't have much time, but I'm happy to dive into some of the Q&A and can follow up with those of you that have questions that we haven't had time to get to, which will be most of them, because there are a lot of questions. So, diving in, are there any other economic components contributing to your industrial growth expectations, or is this simply a function of new builds in ammonia and ethanol? It's largely a function of ammonia and methanol. I'm not assuming, I'm not doing any sort of a GDP growth. It's just new, those new facilities. I've not seen, outside of the financial crisis in 2008, 2009, when there actually was a correlation with GDP growth to industrial demand, the correlation of the two historically was not good at all. It really ends up being the reality when you look back at the chart. The petchem and the chemical and refining sectors are by far and away the biggest components of our industrial demand, and then you have some other things like food and beverage. I mean, that's very economically insensitive and isn't really a growth industry anyway. Clearly, the economy impacts steel, but that's kind of specific to that sector. And when you get into the chemical sector, it's a very specific segment of the economy that, again, the ammonia to nat gas price, for example, right? I mean, that has very little bearing on the overall GDP outlook and the U.S. economy, but it has huge implications for that particular part of the equation. And we've seen, back in when we had hurricanes and prices went high enough, all sorts of things happen. You can get that you can literally get ammonia plants to shut off and not run, and you can shed some demand that way. I've not factored any of those things in. I've just sort of said, I do actually, in fact, pull in prices for ammonia. They are still in the money to run on a forward basis to the extent you can see forward ammonia prices. If that were to change, I have the ability to ramp down the utilization of those plants. It's a fair question. But I haven't built a model like LNG at this point, and still just assuming that that these things run. They are meaningfully still in the money, and we still import. We will still be a net importer of ammonia even after the new builds come online this year. And even with that even being said, CF is planning to export some urea out of its Donaldsonville plant to South America. And so that it seems like we'll be able to probably run the ammonia plants and the nitrogen plants. And that the extent to which we would turn them off would be the U.S. market. If we got tight on gas and needed to turn that off, it could rally. Do I see a correlation with Canadian production to Mexico demand from the Mexico reform? I don't connect Canada with Mexico. They're all done independently. Canada is a function of prices, we believe, and we forecast. I don't run the supply side forecast. Randall Collum and his team run the supply side forecast, so I can't necessarily entirely speak to it, other than that I know they do it based on our understanding of economics and how many rigs are going to run and how many wells are going to come online. As I mentioned, Mexico is just a function of the continued growth in their market of underlying industrial demand. I have time for one or two more questions, and then this is a very good one that I did want to dive into, and I'm glad somebody asked it. Can you go into a little more into why the hub price matters more for power than the EIA Form 923 reported prices contracts? And how would you reflect water storage in your hydro forecast? Those are both good questions. My hydro forecast, outside of this season, I just assume average, normal hydro output. And in this season, we have, I actually do go and look at the current water situation in various basins in the West. And obviously, we started out with a very strong hydro year. What we've actually found is we're getting early hydro, strong hydro, but we're starting to get to a point where the what was above normal is now starting to look a little bit below kind of the median or average sort of history, 30-year normal, if you will, in terms of hydro, because we've gotten some earlier melt. And I try to take that into account. And I actually recently lowered my hydro forecast going forward as a result of that. Why does the hub matter more than, they're asking 923 prices, I'll just say then some of the other basis prices. One of the things that when you dive into the fuel switching is that, for example, in New England, Algonquin matters for NEPL or Northeast ISO, but there was very little coal generation you have to be burning coal to begin with in order to displace it or to switch it. And there were only a couple of gigs of coal in existence in the Northeast to start with, and in the many summer months you've already seen that go to zero, and you can't go lower than zero. And so, the Algonquin price with respect to New England doesn't matter much. New York has more coal than New England, but not much. And so the whole sort of Algonquin link to fuel switching, it's not totally irrelevant, but it's not very relevant compared to other parts of the grid and the country. It's just there's not a lot of coal to begin with there to displace. Same would be true for California. There's no coal in California. SoCal and PG&E prices simply just don't matter. There's very little coal even on the West Coast. And then when you look at where we have seen fuel switching and we have seen the gas increase and the coal decrease, the bigger areas have been the Southeast, the South Central, and the Midwest. The Mid-Atlantic is the one other region we're talking the PJM, sort of conventional PJM, Pennsylvania, New Jersey, Maryland. That's an area where you pick your basis point, and you can choose M3, you can choose Dominion as a representative price for that area. It does matter, and I choose to use the Dominion price. It's debatable. Maybe it's a blend of the two. But ultimately, the majority of the switching and the majority of the needle being moved is in the central time zone and then the southeast. And if you're talking about the south central region, that's, maybe it's ship channel, maybe it's hub, maybe it's, you can argue it's a SONAT price. But those prices for the last several years have not been meaningfully differentiated from the hub. So while, yes, they are not exactly the hub, they're not materially different, and at least from an indicator perspective, if we're talking about a dollar rally or a dollar decline in aggregate prices at the hub, you've basically seen a dollar increase or dollar decline in prices SONAT delivered or on, Ventura prices or Chicago or, outside of some days in the winter where it gets cold. For the most part, the hub ends up being, an indicator in terms of big sweeping moves in price that really holds in all those regions outside of New England and sort of the Marcellus region or the PJM East region. And with that, we were hitting 11:30. There are a lot of questions that have been unanswered, but we are out of time at the moment. So I will have to follow up with you after the fact. I appreciate everybody joining the call, and thank you guys for joining.
Thank you, everyone, for joining. Just a quick reminder that we will be sending the recording and slides out to you by email early next week. If you do have any more questions in the meantime, please feel free to email marketingteam@genscape.com, and we'll make sure that those get included in any answers that we send out. Just a quick reminder also to please fill out the survey at the end so that we can take your feedback and incorporate it in future presentations. Thanks again. Have a great rest of your day.